Las Vegas, Nevada, I'm Allison LaForgia, managing editor of HousingWire's content studio. And today I am with David Bernard, senior managing director of specialized mortgage services at Western Alliance Bank. Thank you so much for being with me today.
Thank you for having us, Allison. I appreciate it.
So David, I want to start with your background and how you came into your role at Western Alliance Bank on the specialized mortgage services team.
Yeah, it's been a while. I mean, it's in the industry over 20 years, coming up on 25 years, a couple of different banks of different sizes, but this is my 12th year at our bank. Our bank started mortgage warehouse lending in 2009.
Okay.
The gentleman that started it is the chief banking officer at the bank. His name is Steve Curley, and there was kind of an outflow of lenders leaving the space during the great financial crisis. Our bank's headquartered in Phoenix, and there's a lot of mortgage activity in the Southwest. And so we stood up a warehouse group, and it was growing and evolving. And I joined the bank at the end of 2013 as, we were kind of growing that platform and ready to kind of take it to the next level. So, Steve and I grew that together.
Now, Western Alliance Bank has built a reputation for being both innovative and relationship driven, which is pretty special.
Yeah.
So could you talk to me about what the core value proposition is behind the specialized mortgage services group construct? And really, how does it set you apart from traditional mortgage banks?
It's a good question. So our bank is a commercial bank. So when I joined, our bank was about $10 billion. This is at the end of 13, kind of purposely stagnating there, ready to cross over that $10 billion threshold. We're a $90 billion bank today. And, it's a commercial bank, so there wasn't a mix of consumer banking, kind of retail, and commercial. It was commercial because hard to really compete at a scale level with money center banks and super regional banks doing a lot of retail. So we kind of took that same proxy in building, our group. We launched a warehouse lending platform. We didn't intend on being all things to everyone. Our group's pretty price competitive, but I wouldn't call us a price leader per se. I would call us a leader in listening, being creative, following through, and forming long-term strategic partnerships. That's really been our kind of ethos. That's been our value proposition of the marketplace. When I joined, beyond traditional warehouse lending, the risk committee had approved a couple of different kind of debt products, MSR financing. We do something called note financing. And so we had kind of multiple lending vehicles to face the marketplace with. And the thesis was that some were going to be more or less applicable based on volumes, the rate environment, and how independent mortgage banks grew, whether they held servicing, whether they needed financing on different kinds, an expanded array of mortgage products. And so over time, we were not trying to be all things to everyone. We were just trying to have a full palette of products and services that we could grow with, our business partners.
It sounds like the team that you built has experience that spans mortgage finance.
Yeah.
So I would love if you could break down some of the key components that define the specialized mortgage services group and how that contributes to your overall mission of serving clients across the mortgage lifecycle.
So when I knew Steve just from being in the industry, so when I came down and spent a few days in Phoenix learning more about the bank, it was pretty quick to me, like, gosh, this is a flat, dynamic organization. And the bank's still the same. I mean, it feels the same. So what we've tried to do is...
Despite tremendous growth.
Yeah, despite growth. It's still, I went down and I walked down and I go, geez, this feels like 70s community banking. Like I could, our customers still talk to our C-suite. The C-suite travels. We have customers come in, we sit down with them. So what we endeavor to do is really build relationships throughout our organization. If we're doing our job in being holistic, our customers know our credit group, not just the credit analyst that covers them. They know the credit manager, they know the assistant manager, they know the operations team, they know their funders, they know the people that handle their collateral, they know the treasury management team that they work with and open up accounts. And so when they come in, we have kind of group meetings. We provide feedback. What can we do better? What ideas do you have that we can try to work on together and be strategic partners? So it's really been, I get this question a lot, it's really been three things. As simple as this, and it sounds like I'm being trite. It's been listening, coming up with strategic plans and following through. And 85, 90% of the time, we do some pretty special things, and I think our partners appreciate us for it. That's what we're known for in the marketplace. And the 10 to 15% of the time we can't do that, we give somebody a quick no and say, that I understand what your need is. I don't know if that fits what we can get done from a credit perspective, or just in the time that you need it done. And respectfully, like you need to go find a solution, you should find a solution somewhere else. But 7/8 of the time we end up being that person, and that makes it exciting for everybody. So we share that ethos with our team. It makes them feel excited. We're transparent with them. We share successes. We highly promote interactivity with our customers, so they feel part of that success and that growth, and that's led to the success we've had.
Now, it sounds like you've built a culture around that banking feeling that everybody really loved in community banking, when you used to walk into your bank and know your banker and be able to ask questions and say, hey, David, you have great experience here. Be my advocate, be my advisor. And I'm really curious to get your perspective, because we've gone through a year in 2025 that's been transformative for the industry. So I'd love to, if you could walk me through how this year has been different for Western Alliance Bank, maybe compared to what we had seen in 2022 through 2024.
This is it's an interesting, I'll give you an interesting statistic that surprised me. So through the first 3 quarters of this year, we've had more funding growth than we had in 2021 when rates were at historic low during COVID.
Really?
With actually fewer customers. So
Okay.
how was it? It was our value proposition. So we never intended to be all things to everyone and be this monoline conforming funding lender. We endeavor to understand different products, different markets, the investors, the execution on the secondary, the capital market side. And then so we fund a wide array, not to wander outside any credit risk guardrails, but when you actually listen and roll up your sleeves and put some elbow grease into structuring warehouse lines or MSR financing or note financing lines, or working on somebody's treasury need, then you develop these relationships, and then they tend to be long-standing. So, we started funding non-QM, for example, in 2013 when I joined. We fund seconds, HELOCs. For the right customers that have a core competency, we do construction lending and bridge lending and early buyouts, and we do hospital loans and cash buyers if our customers have those programs and want to leverage them on a warehouse line. So I think as rates went up in the last 3.5 years, and people weren't relying on just agency refi, they had to broaden out their product spectrum. We were already doing that. So now it's our lines are utilized on a more regular basis across their tranche spectrum. And our outstandings have stayed up. And I think when people have looked at who's been my partners in good times and bad times, then they'll say, I had 6 lenders and I really only need 4. Or I have 4 lenders and I only need 3. And we've grown our market share while the market's kind of receded a bit.
Now, you just talked about partnerships. And I know that Western Alliance Bank and AmeriHome Mortgage have developed some strong synergies across mortgage and servicing. How are those integrations driving new efficiencies and opportunities, in addition to the ones that you've just mentioned previously in our conversation, for clients within your platform?
AmeriHome is the largest bank-owned correspondent lender. I think we're the 3rd or 4th largest mortgage company in the country. And they were a large client, one of our largest clients, before the bank acquired them in 2021 into 2022. They've got an amazing platform, bidding loans, buying loans, and a very similar mindset about customer service and long-term customer partnerships, relationships. So culturally, that's always the hardest fit when you have an acquisition, when you have two companies and strong, hard-charging groups merge. How's the culture going to work? It was very like-minded. We had an early thought about that because they were a customer and we knew we aligned very well. Yeah, so we had a little bit of a sneak peek there. And then when it did, and we still have a lot of runway to grow with these synergies, but when we provide warehouse leverage, they have an expanded correspondent product set. So they launched non-QM this year as a product. They'll be launching, HELOCs and ARMs and other exciting things that we fund. So the common customer, our borrower and their seller, can utilize warehouse leverage to more efficiently sell them loans by funding through us. There's some economic benefits to the customers there, and advance rate benefits there. So there's some real wins for the customer. There's better synergies. And then in their post-closing, their funding groups, there's a tighter transaction. So they actually have a savings of time. Like loans get purchased quicker. We fund them, they're going to our conduit. So there's some economies that they can pick up through our partnership.
Now, you just mentioned growth opportunities from partnerships, and you've mentioned the growth that Western Alliance Bank has had in the past several years, even most recently in 2025. Now, that's pretty impressive given that we're in an environment noted by volatility, regulatory, and technology, where we have all of these regulations that are coming together that make growth or can make growth particularly difficult. So what do you believe distinguishes Western Alliance Bank as a leader in the industry? What's given you guys the legs for this growth?
I think the relationships. It all comes down to relationships. You could have as much technology, automation, and borrowers, independent mortgage bankers can look at warehouse lenders as, that's my banker, that's who funds my loans, in kind of a commoditized asset. But if you're the right customer fit for us, you're viewed as a strategic partner. The biggest compliment any banker can get is when their customer, especially this time of year, we're coming up on end of year, people are looking at their budgets, their strategies, and if they invite their banker to be part of their think tank, hey, I'd love to bounce something off you, Allison. We're thinking of expanding here. We're thinking of going into new markets, new products, raising capital. How can you help us structure that? Can I just get your thoughts as a banking partner on that? That's the biggest compliment you can get. Then you're part of their franchise value. And then, as they have different needs that come up, we can align with those needs. So over the last 3 years, probably arguably back when the government tried to kind of enforce some quantitative tightening in 17 and 18, those were kind of lean years. And then they kind of backed off. Our borrowers, when they engage with our banking partners, not only our banking partners, we have a treasury team in our group. So, our team is made up to be holistic and solution oriented. So, we've got the warehouse lending group. We do MSR financing. With the MSR financing, we've got an entire treasury team that sits in our business line and handles large custodial escrow accounts. A large percentage of our customers have their core operating accounts with us. We do corporate credit card. We have customers that do self-servicing or that are sub-servicers. They remit their T&I and P&Is through the bank. We're their core banking partner. And we have a tech group in our group that builds out the treasury management. That part of the industry is evolving very rapidly with technology, and that's exciting. It's exciting for us to work on. So we build out new efficiencies, payment rails. They have technology partners that, like a modern treasury, somebody that's helping them move money more efficiently, and we build with them at the same time. So when our customers, are growing and kind of more automating their processes, we've already done some of this foundational work to make that work inside, so we can kind of turn on and off new partners as technology evolves. So that's kind of our value proposition. So that's why in a year where it's kind of, it's been better than in prior years, but still challenging for IMBs, that we've continued to grow our wallet share and grow our customer base and continue to be excited. I would say back in 17 and 18, when the government tried to kind of ease off of the quantitative easing and enforce some quantitative tightening, the market didn't react well to that, so they kind of backed off. IMBs got their first taste of looking at cost, hard costs, and cutting. and doing reductions in force and looking at their spending. So they had already had a little bit of a foray into endeavoring that exercise. When rates went up in the spring of 2022, they really had to enforce that. And customers were doing 2-3 cuts a year over year, because the volume was tough to come by. It was all purchase and it was higher rate. So they've been through these cycles. I think they have their companies to where they're going to be profitable and then just move forward from here.
So I have to ask you just touched on a couple different cycles that we've gone through, the evolution of how Western Alliance Bank has handled those cycles. We're about to head into 2026. How is Western Alliance Bank positioning itself for the next cycle, and what gives you optimism about where the industry is heading?
I think, well, for some of the pieces we touched on before, I think there's a growing breadth of products. People are learning about that. Our industry is supported by some interesting buying options. There's flow, there's bulk, there's securitization, there's private equity, there's fund money, there's insurance money. So, the correspondent space is kind of expanded right now. And the customers, again, have really done a nice job optimizing the operating efficiency in their companies. Those that have gone through and looked at new technologies or looked at offshoring for efficiencies, they've had to endeavor going through those exercises. So they've done that. So I look at 2026 optimistically. I don't think that it's going to be easy for customers to grow. I think, like the MBA is predicting, I kind of agree with the rate environment that they're predicting is going to be kind of low sixes, 6.25, 6 3/8. And IMBs are going to have to close loans, in and around there. There's more arms, there's more efforts to tap into some of the untouched equity in loans that were done during COVID in low rate environments. So, HELOC, arms, some refinance, some cash out. I think people are getting, the consumer is getting used to
that type of product.
The 6, like a 6 handle. If they had a high 5 handle, I think maybe all the better. But the MBA is predicting, I think, about $2.2 trillion in mortgage origination in 2026. And the industry is the new normal is now, and I think the consumer is also identifying with that.
David, thank you so much for spending time with me today talking about the specialized mortgage services team at Western Alliance Bank. It sounds like you guys have had a very successful 2025. I can't wait to see what 2026 has in store for you.
Thank you, Allison, and thanks HousingWire for hosting us today and for all you do to advocate for our industry. We sincerely appreciate it.
Thank you.
Thank you.